Is it still a good time to buy a home in Orange County? Everyone's been hearing about the crazy home value appreciation, bidding wars, and many other reasons why it's currently such a great time to sell a home, which has discouraged home buyers from entering the market. In this video, we're going to discuss several reasons why it may not be a good idea to wait if you're thinking about purchasing a home. We're also going to look at some very interesting graphs that tell a little bit more of the story as far as the national housing market is concerned. So we're going to look at the Case-Schiller Home Price Index, that same index adjusted for inflation, a comparison of the home price to median income, and a comparison of home values to the stock market values. I'm Tim Hamilton with StellarQuest Real Estate, and this is our August housing market update video for Orange County. If you're thinking about buying or selling a home in the area, please feel free to call or email me anytime. All of my contact information is in the description below. First, we're going to look at the information that was put out in the most recent Orange County Housing Report by Stephen Thomas. He boils down the housing market strength simply to supply and demand. On one hand, we have an extremely low number of homes listed for sale and fewer homes coming on the market every year. And on the other hand, we have strong buyer demand compared to recent years. You would think that record high home values would incentivize more homeowners to list their home for sale and cash in on their gains, but so far we have not seen that happening. Fewer homes coming on the market has actually been a trend that has been developing over the last 10 years, which seems to have been accelerated by recent events, which I can't say by name because YouTube doesn't seem to like that. From 2000 to 2008, there was an average of 1,347 more homes hitting the market in Orange County every single month. So that ends up to 39% more homes hitting the market every year. The obvious question is, why are fewer homeowners deciding to list their home for sale? First, many people have the Great Recession fresh in their minds, so they've decided to stay put and create their forever home rather than stretch their finances by going out and purchasing a more expensive home. The second reason is more baby boomers have decided to stay in place rather than downsize. Baby boomers have downsized at a much slower rate than previous generations have before them. The final reason is there are people out there who really would like to sell their home and make a move and purchase a replacement home, maybe upsize, downsize, whatever they want to do. But they've decided to just stay where they're at because they're scared that if they get their home sold, they won't be able to find a suitable replacement home, which will leave them in some undesirable circumstances. So we have some strategies to successfully navigate that process if you're one of those people. But this has been something that has created a roadblock for some potential sellers. So we have a situation where as less homes come on the market and the inventory shrinks, it actually causes fewer and fewer homeowners to want to sell their home. So this trend continues. Until we see this trend reverse, we are probably unlikely to see home values really start to make any significant declines because we also have a strong demographic of buyers coming into the market. So as long as we have record low numbers of homes on the market and strong buyer demand, home values are likely to at least stay where they're at or increase further from where they currently are today. Now we're going to do something a little bit different by looking at a few charts that tell a little bit better story about the housing market as a whole across the entire country. And so I will be leaving links to all of these charts in the description below if you want to click on them and learn a little bit more about each chart and how it is derived. So this one we're looking at here is the Case-Schiller Home Price Index, which is an attempt to track the national home values across the country and is one of the most widely looked at and respected charts for national home values. So you can see that we are currently well above the previous peak back just before the Great Recession. Home values have been increasing fairly steadily since 2012, and then you can see a sharp increase in home value appreciation that started last year. And so this chart actually only goes to May 1st of 2021, so we're missing a few months of data on the end, and it'll be very interesting to see how long the chart can remain at this steep of an increase. Now we're looking at a graph that attempts to adjust home values for inflation. So this graph is a ratio between the Case-Schiller Home Price Index, which is the graph we just looked at, and the Consumer Price Index, or CPI, which is the most commonly referred to measure of inflation in the country. So despite the fact that the home values are much higher today than they were in the last peak, just before the Great Recession, you can see at this graph, when we adjust it for inflation, the home values today are actually very similar to where they were in the last peak, just before the crash. So now we're looking at a chart that compares the stock market to home values. So this is a ratio between the S&P 500 to the Case-Schiller Home Price Index. When you're looking at this graph, as the graph increases, it means stocks are outperforming real estate. So you can see that they clearly marked, and it's very visible on the chart, the 1929 and 1999 stock market crashes. So you can see there was a massive run-up where stocks were massively outperforming real estate, which then led to a crash in the stock market. Another interesting thing to point out is the 2007 financial crisis. You can see here that the ratio was actually relatively low at that time because home values were increasing at a much better rate compared to the stock market during that period leading up to the crash. So in this instance, looking at the last few years, you can see that the stock market has dramatically outperformed real estate home values, despite the fact that real estate values have been increasing at a very solid pace. So you can see that this is, we're at a more similar ratio as we have been in the past compared to a stock market bubble as opposed to a real estate bubble. Now we're looking at a graph that compares home values to median income. Historically, on average, it took about 5 times the median annual income to purchase the average priced home in the country. We reached our peak at just over 7 back in 2005, which was leading up to the Great Recession. As of March of this year, we're currently sitting around 6.5 and rising at an extremely sharp rate. I would like to point out that this graph is heavily influenced by the interest rates at the time. As interest rates decrease, purchasing a home becomes more affordable in terms of the monthly mortgage payment. So as interest rates decrease, the monthly mortgage payment becomes cheaper, and people tend to spend more money on homes, which drives up home values as a whole. So regardless of the fact that this chart can be impacted by interest rates, it is still extremely interesting to watch and keep an eye on. Thanks for watching. If you want to stay up to date on the housing market, make sure you subscribe to our YouTube channel where we upload our monthly housing market update video and videos on a variety of other real estate related topics. If you want to read the most recent Orange County housing report, feel free to let me know by phone or email, and I would be happy to send you a copy. If you're thinking about buying or selling a home in the Orange County area, please feel free to call, text, or email me anytime. If you have questions or would like to get the process started, I'm more than happy to help you with that.